Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure. Please feel free to take a screenshot of it now if you like, but again, that's the main point to take away from it. Other than that, the market bounced this morning, but it's given most of it back. So does that mean the bounce over? Let's ask the expert. Rob, I see you joined. You out there?
I am Zach. Happy Tuesday afternoon to you, and welcome to TradeFinder Live, everybody. We'll take a look at where things are. Quite a few things to talk about regarding the chart currently right here. If you watch the U.S. market update, you know we nailed this zigzag pattern to the downside. Didn't expect that extended level to be hit in one day, but it was. We were calling for 540. We got that. And then we went down to the 161.8% extension on the low of yesterday's trade. The problem was yesterday we opened here, we traded lower. We have the separation from the 10-day moving average. The stage was perfectly set for an oversold bounce. And then that rumor came out that President Trump was considering a 90-day pause on the tariffs, and the market rallied like crazy, setting a record on the Dow for intraday price movement in one day. We kind of had the same thing in the S&P. But what I was wondering is, did that take some of the energy out of the potential bounce? We opened higher today. As Zack mentioned, we've given most of it back. We're still up a little bit on the day, but not much. And the issue is that on the high yesterday, the high today, we are not that far from the 10-day moving average anymore. So we're no longer in that severely oversold condition where you'd look for a 1 to 3 day bounce. So I feel like the bounce this morning was muted a little bit due to the fact that we had that big intraday rally yesterday, even though once it came out as, quote, fake news, we reversed back down. We didn't finish anywhere near the lows of the day yesterday, finishing right here in yesterday's trade. And then here's today's bar. So you can see there's still a gap. So there's still potential for more movement to the upside, but we are not nearly in the severely oversold condition that we were just on Friday's close. So brings a little more doubt into how much more of a bounce we're going to get. I think the market was hoping that the administration would announce some things over the weekend. I didn't feel like we were going to get any news over the weekend. I didn't think that made any sense. I felt like if President Trump is worried about where the market is, any deal making would be released before the market opened yesterday, not over the weekend, to where the futures had a chance to digest it. And so here we sit in a state of limbo right around the 100% extension. I just want to remind you on Elliott Wave rules, when the B wave corrects 38.2%, your first level is 61.8. Well, we championed that because we hit that. Didn't think we would go to the 100% extension in one day. That's always a possibility to have a C wave extension on a zigzag pattern to move to the next fib level. Doesn't often occur on one day. And again, on yesterday's open, we were so far oversold, we were due for a bounce. And just that news, fake news that came out, and it makes you wonder about ulterior motives, right? Because that was a social media post. Basically what happened was they took a very vague comment from an interview with the Treasury Secretary, and people interpreted it into some sort of a story that President Trump was considering a 90-day pause. That was never even talked about, nothing about 90 days. It was a question that was asked and a vague answer, but social media seized on it. And you know how social media works these days. And it created the short covering rally yesterday that I was looking for if we had finished, we didn't have to finish on the lows of the day yesterday, but just somewhere down in here. So now we wonder at this level, does the market hold here? Again, giving up most of the rally, we're almost back to the flat line on the S&P after being up nearly 200 points earlier in the trading session. So yeah, it makes things a lot tougher as far as where we go from here in the US market. I don't think we're done to the downside. The only question in my mind was how far up do we bounce before we turn and head back lower? Markets correct extreme moves in one direction or the other. And I think when you're looking at the short term, for those of you that have been following me for a long time, and I know there's a lot of you that are newer, know that when we start talking about these overbought or oversold conditions, they last a relatively short period of time. So we already went to the first level of expectation, the next extended level, and then this is very rare to go down 2 extensions on the C wave. Again, I felt like we might have had a stronger rally if we hadn't taken some of that oversold pressure off during yesterday's rally. So the only question now is, are we able to actually rally back up to the 10-day moving average before we reverse and head back down, or are we done at this point with the rally and then we turn and head back lower? The wave 3 is still green. That's probably what should concern people the most. I don't see anywhere in this bounce that we could label a wave 4. So if we reverse and head back down, we're likely to stay in that wave 3 to the downside. For those of you that are newer to Elliott Wave, every 5-wave pattern, every single one starts with a zigzag pattern. So you start with the ABC, which we did. Remember, I had to go back and change the plots to 100 data points in order to get an Elliott Wave pattern. On the full 377 data points, we were only in the zigzag pattern. But now on the longer term, we have labeled the 1, 2, 3, common practice after an ABC zigzag start to an impulsive move. So where does the wave 4 begin? Is it a ways off into the future? Do we revert back down and head down towards those lows that we had yesterday before we get the wave 4 bounce? Or are we able to turn this thing around at some point today and perhaps rally back higher? It's going to be really interesting to see where we close today versus where we are trading right now. But those are the issues. So perhaps you had to be quite nimble on the oversold bounce that I was looking for, or maybe we can turn this thing around into the close, finish more near the highs of the day, and then follow through and fill this gap. It's almost too perfect to set up more downside, to have a bounce up here and fill the gap and then reverse over. That's the ideal scenario and very classic setups. And the market doesn't always give it to you that easily. It doesn't always give you what seems the most obvious to happen. So got to be a little bit nimble at this point right now. We're actually down on the day now, where we were nearly 200 points up. So if we are going to turn this thing around, it needs to happen very, very soon. And if it doesn't, then I think we're definitely going lower. We might even close lower on today's close. So we're just going to have to kind of sit tight, wait and see what the market gives us into the close today. And, you know, the wild card that's out there is always, we don't know when President Trump may come out with some sort of a tweet. I know he's getting some pressure to do something to squelch this concern in the markets. If we take a look at the chart of the VIX you'll be able to see that the VIX has moved significantly higher. I had written some commentary last night for our subscribers at EWO Trader that perhaps we were poised for a bounce with the fact that the VIX spiked up to 60 yesterday. We're down at 47 now, so you can see where we are here. And maybe at this point, we still have enough of a spike, but we'll have to wait and see. Normally, when we get these kind of spikes in the VIX, if I condense the chart in, you can see that the last time was in August when we spiked up into this area and we immediately came back down and headed lower. And that's what usually happens with these volatility spikes. But so far, that hasn't occurred yet. But we have to keep open in our minds the fact that we could still bounce a little bit more and fill this gap. I just a little bit concerned about the fact that that rally yesterday took some of this oversold energy out of the market, and this is what happened. So, yeah, difficult market to figure out. If you were looking for that bounce, hopefully you were quite quick and nimble and took advantage of it. But if you didn't, then now we're in more of a, all right, we need to see where we close today and specifically where we open tomorrow. Is there a possibility that this wave 3 goes lower than the low yesterday? And the answer to that is yes, it's a possibility. This zigzag is pretty much done. That's the thing that if you're bullish that I'm leaning on most is that this is an extreme on having two C wave extensions on the C wave. So that usually generates more of a bounce than this. But anyway, I've given you the dissertation on why it took some of the momentum out. When we look at some of the other markets, I'm just going to jump straight to the bond market because this acting once again quite odd. Other than we followed this 5-wave pattern to the downside to a T. You finish a 5-wave pattern, you go through a corrective phase, flat zigzag or triangle. We had two symmetrical triangles. And we had the false breakout. We broke to the upside. We've already come back and tested the point of the breakout. So we're not getting a whole lot of information from the bond market. It's already done what it needs to do as well. So with that in place, is the equities market still going to take its cue from the bond market, or is it going to be its own animal right now? That's what we're going to have to try to answer as we move forward. So that's the TLT on prices. We go to the TNX on rates. They're obviously opposite. As you know by now, the TLT is prices on the 20-year. Prices and yields move inversely. And so where we had that move up in prices, we had the move down in yields even on the 10-year. And with this move down on prices on TLT, we've had a spike back up in yields and rates. That's concerning. I've talked about this before. The fortunate thing is this 5-wave pattern on the TNX has now been disqualified because that wave 4 went to 82%. So we don't necessarily have to worry about this 5-wave pattern playing out with the wave 5 moving all the way up here. That's constructive. So we can take that scenario off the table. But it still begs the question, where is the bond market going to settle out on rates? We don't want rates to go up significantly because that brings the whole stagflation into mold here as far as does the Fed cut rates? They don't want to react to the stock market. They say they want to react to the labor market. But we're starting to see some cracks in the economy, and that's an issue as far as where we go with the Fed on their timing of cutting rates versus where we are in the market. So, yeah, pretty pretty interesting stuff going on. And that's, one thing that I say that as long as I've been doing this, 28 years, you never say you've seen everything. There's always something unusual that occurs in the markets, and that's just what keeps things so much fun in the world of trading. is you're constantly learning something. Everything's different. I equate that to my experience as a golf pro. And you can play the exact same course every single day as a golfer, but you're going to be in different spots each day. You're going to be in different spots on each hole. So even though you're playing the same golf course day after day, every round is different. And that's how it works in trading. You take as much information as you've gotten from the past, and you apply those rules and guidelines to put as many probabilities in your favor as you can moving forward, always understanding that something that you've not seen before can occur. We don't know that yet, but we'll see if that's how things end up playing out on where we go with the markets moving forward. Let's talk about some of the other U.S. markets. We'll go to the DIA. We'll bring in the international side of things as well. All these charts are going to look the same. There's the bounce, very similar on the Dow. We go to the Qs. Now you have to be really worried about the Qs with the fact that rates are ticking back to the upside because that's going to just exacerbate this downward move. But the Qs are in the same spot almost of the SPY in that they hit the first target at 61.8, but the Qs have only gone down 100%. They haven't hit the second extension on the C wave yet. And with that wave 3 still being labeled as active, that brings into the fact that we could totally reverse here and head lower on the Qs on top of the fact that interest rates are going up. Doesn't seem like a very good scenario for the Qs. That might be the weakest looking of all charts. We go to the IWM and similar to the SPY, we did go to 161.8% extension, but the difference is the B wave on the IWM went to 50%. So the first target was 100. The first target was not 61.8. So that's why you need to understand the rules of zigzags. And we came straight down to this 100% level. We bounced a little bit, and now we've gone down to the 161.8% level, but that's only the first extension on the IWM, where the other markets, other than the Qs, the SPY and the Dow, are dealing with their second C wave extension. So you could argue that the weakest part of the market right now are the Qs and the IWM because they have not achieved their second C wave extension yet. So we'll have to keep an eye on what's going on there. Let's look at the metals, GLD. So we go to gold, and we had that one heck of a run. We've come back down. We've held the 50-day moving average, at least so far, but we're not back above the 10-day moving average yet, even though the wave 3 is still labeled green. You have to be concerned about the fact that we came down to this level and held that. Well, if you're long gold, you're not concerned. If you're long gold, then you're happy about this. We retraced the C wave all the way back to the B wave. This needs to hold here if gold is going to go higher in this wave 3. You would think that if the market falls apart, then that's what's going to happen. Gold's going to get a renewed bid, but for now, at least for today, not happening. And then we go to silver, the one that has not followed suit. We had this big downward move. We had a strangle on SLV, and with the initial breakout, we thought it was going to be the calls that were going to generate a gain in the position, and it ended up being the puts. Just such a quick turnaround from the calls being in the money to the puts moving in the money, which is a perfect educational event on why you're not quick to take one side of a strangle off. In other words, as we started to break to the upside, it would have been easy to say, let me take the puts off, because if we move up, as we move up, the calls are making money, but the puts are losing money. So let's take off the calls or the puts and just ride the move up in the calls. And had you done that, all of a sudden you would have gone from what ended up being a profitable position with the puts moving in the money, you would have been 100% loss. So you would have had these calls making money, the puts weak, so you close the puts off, And then now with this movement down, the calls would have gone down to near zero. The puts would have been already off, and you would have ended up with almost 100% loss on a trade where just by being patient and keeping both legs on, we ended up with a gain in the trade. So kind of a lesson on these strangles on what you need to do in order to stay in some sort of a realm of rules-based trading on the strangles that we talk about. Let's move to energy. Sorry, I keep looking over to see what's going on. I've got multiple screens going on here because things are moving so fast. Natural gas gave up the ghost. We wanted to see if it could hold the 50-day moving average. We talked about that over the weekend, and then yesterday and today, both breaking below the 50-day moving average. We have a wave 4 here at 48%. We talked about maybe there was a possible impulsive move. In other words, the wave 5. We talked about that last week during TradeFinder, but we needed this breakout here to continue. And coming back to test the 50-day moving average was not concerning, but yesterday's close broke below that. You know the rules. You have to have a follow through a confirmation day, and at this point, it looks like we're going to get one. The wild card here is, can this wave 4 hold? So you don't necessarily want to turn around and go short natural gas just yet, at least on UNG. We want to wait and see if we can get some sort of a bounce off this wave 4. But if it does appear that this 5-wave pattern could become disqualified, we could see a renewed downward move and possibly even relabel this chart. But for now, you have to respect that this is a level that could hold on UNG, just like the 50-day moving average could have held, which did not. A 50% correction could hold. We were going to want to watch and see that over the next couple of trading days. And then oil, talked about how I wouldn't be surprised to see a test of either of these two levels, whether we went up to 80 or down to 65. You know, this is the big range that I think oil is going to stay in for the year. Right when it looked like we're going to go up and test resistance, boom, immediately reversed and headed back to test support down here at 65. So can this level hold on oil? I know that not only is OPEC getting a little concerned about oil dropping this far, but so are domestic providers here in the U.S. Remember, Trump's drill baby drill was to encourage U.S.-based companies to expand their drilling and then create a lower price in oil because of the excess production. That wasn't what OPEC was looking for. OPEC was just like, okay, if you increase more production, we're going to lower it. But they're also very sensitive in the price going up to lower demand. But now we're getting to the point where this is the lower end of the range that OPEC wants to keep oil. But we're also starting to get down. We're not there yet, but we're starting to get down to the price where domestic companies will not be encouraged to drill, baby, drill. Because if the price of oil comes down too far, they can't make money. Initiating new drills, all the expenses that go into creating more drilling. That's a concern there. So I think with all that said, we have a chance of holding support down here somewhere on oil. We may see a little bit of a bounce as now the threat of increased domestic production has waned a little bit. It's stopped just a bit. So we may not see that movement continue lower on oil. And maybe we just kind of hang around in this area here for potential continued move lower. So we'll just keep an eye on where things go in the whole oil scheme of things. Again, forgive me for multitasking while I'm talking to you, but the market moves quickly. Just want to keep an idea of what's going on in the markets. So now we move to the cryptos and we take a look at Bitcoin. And Bitcoin has held in there pretty darn well. And I'm not going to show you the data of the rest of them, but we did go down and test 75,000 on Bitcoin, which I thought we would, and then we turned and rallied back up. So we got to keep a close eye on what's going on in the whole Bitcoin space as far as the challenges of holding support at these levels. Otherwise, it gets really ugly in crypto land. And the comments were pretty interesting on where we were with the crypto space on the US market update that came out. So if we look at the INDA, see if we can get the Nifty on here. There's the Nifty for the India market on the move lower, and just different chart from the INDA where we are still in a wave 3 to the downside, and this bounces a wave 4 on the Nifty. That was in the INDA, but on the Nifty, it's saying that this is the wave 5. We're below the midpoint of the tap box, almost to the lower end. So we were set up for a bit of a rally here. We had more of a triangle formation on the INDA than we did the Nifty, but we rallied up, and now we came back down, tested the 50-day moving average on the high, have rolled over. Can that wave 5 extend? Or if we take out this wave 5 low because it's already showing as an extended wave, does that relabel to a wave 3 to the downside and match what's going on the INDA? That could very well be where we go there on the Nifty. Looking at the land down under on the EWA for the Aussie market, we can see that we broke below 23. We talked about in the weekend update, we had this corridor here between 23 and 24. We needed to really stay there, and we didn't. So we are in no man's land on the Aussie market, even with the price of metals holding in there. It creates this really uncertain. Look how far back I go with 23 being support on the EWA. And if that doesn't hold there, we're likely coming all the way back down to 21. And look where we are. We came right down to that level. So I'll condense the chart again because this is really important to look at when you're looking at charts. If you break one level of support, where's the next level of support likely to be? It would be right in this area, which is where we are now. So you break one level of support and you're going to go down to the next one. And oftentimes it occurs just like this, very quickly. So can this wave 3 hold this level of support on the EWA? We're still a little oversold, but just like the SPY, not as much as we were on the low yesterday, and kind of challenging to figure out where we go here. I can tell you if we break this level of support, then you want to short this, because if I condense the chart in again, if we don't hold that level, then we're coming down here below 20. So the next level of support would be down here. And even though that's not too far away, it does create a little bit of a corridor, just like we had here between 23 and 24. We have another corridor here between, call it 19 and a half and 21. So far we've held that and bounced up. But if we don't hold that, you know where we're going. We're going under 20 on the EWA. The chart that I think fascinates me the most with all of this stuff, all this news, all these things that have been talked about is the market in Canada. I don't know why it took so long for the Canadian market to fall with all the rhetoric that had been chatted about and all the comments going back and forth between the US and Canada. it held in there for quite some time, but the beginning of this week was just too much for it, and we fell down. And there's the little corridor down there that we bounced off of. So these provided some short-term support, and now we have the same question that we have here. Is this wave 5 good? It was extended at 135% on the extreme low yesterday. So we bounced back up, but you can see we reversed here. Does that change to a wave 3? There is a limit to how far you will extend on a wave 5 before it relabels to a wave 3. Remember, the wave 3 is the strongest of all waves. So if the wave 5 comes down and it's showing increased strength, there's a high likelihood that 5 will turn into a 3. I don't know that yet. One tweet, one false news article yesterday created a massive rally. That's the kind of market that we're in right now. I posted in the commentary the market's jittery and just seems right to go ahead and react to any sort of a news event that comes out that could be significant. And so here we sit with Canada wondering if there's some sort of a bounce here. The fact that there has been chatter, which created the bid under the market in the morning on conversations being held, negotiations, if you will, with other companies, other countries, created that. You saw what happened in the rally yesterday. Another headline like that sends us right back up, which is what makes all this challenging on whether or not this relabels to a wave 3, or do we recover back up towards where that wave 4 was. Remember that if the wave 5 extends more than 100%, you only look for a 61.8% corrective move. So that brings us back up to the 10-day moving average, which we almost hit back on Friday, but that doesn't count because we ended up finishing lower. It's yesterday and today that you want to look at towards the bounce back to the 10-day moving average, which coincides with the 61.8% level, which is where you normally bounce back up to when you've had a wave 5 that is complete and extended more than 100%. You move back to a 61.8% level. Let's take a look across the pond. This should be quite interesting to see what's going on in the German market. So if we take a look here, you can see that we had this big move down in the wave 4, almost to the point of disqualifying this 5-wave pattern. I think that's probably likely, but we're holding at the last bastion of support here. We haven't quite made it back down to the point of the triangle before that big move started in the EWG. It held in there pretty well also, but just like Canada, but gave up the move here. And I think we have more downside to go on the EWG. I think this 5-wave pattern becomes disqualified, and we eventually make it down at least to this price level here at the point of the triangle. So the move lower in Germany is a little further separated from the 10-day moving average than the other markets we've looked at. But it's not so bad. I talk about this rule, no security in any time frame gets too far from the 10-day moving average so many times, but there are varying degrees, and when you have a downward move, the separation from the 10-day moving average can last just a touch longer than a separation to the upside. Not a lot, but a little bit. In other words, when we separate from the 10-day moving average on a downward move, we can separate a little further for a little longer than we do on an upside move. A lot easier to figure out when you're overbought than when you're oversold, other than just looking at the sheer distance between the two numbers. I do think we should take a look at the China market. So if we take a look here on the China market, just kind of gave up everything there. And that's to be expected. We did start coming back down. We ended this big rally on the market on the FXI when the news came out from President Trump that anyone buying Venezuelan oil was going to get an additional 50% tariff. He's angry that Venezuela seems to be exporting some of their gang members to the U.S. So he was upset about that. And China's the biggest purchaser of Venezuelan oil. That stopped the upward move, and we've pretty much been coming down ever since. So there was a big bid under China. You could make an argument at this point that right here, if I'm looking at the charts, the one that seems to be the easier trade to figure out is a bounce back in the FXI. So holding the 30 level, which has acted as support for a really long time, a little further oversold from the 10-day moving average even than we are in Germany. So maybe since we've retraced this entire move, this is a level that you could at least see a short-term bounce. And again, when I'm talking about short-term bounces, my definition of that is 1 to 3 days. So they're short moves, they're quick moves, and that could be where we end up on the FXI. So that one looks the most interesting to me. And Zach, that's going to be, because of everything else is going on, our case study consideration for today. But as the last 2 weeks, because these charts aren't following all the rules, this will be a post, not an idea. And you can explain to the folks towards the end what the difference between those two are. And for now, that covers pretty much everything that I wanted to share with you. So if we have any questions, I'm happy to take those now.
Yep, sounds great, Rob. Let's get right into it. So we have a question here from a couple symbols from Lisa. In times like these, do charts BB, and I'll give you the other one, matter till things even out or chill for 1 or 2 weeks?
Well, BlackBerry, gosh, we haven't looked at that in forever. But to answer the question, when you have extreme volatility like this, it really does make things more challenging to figure out. So having a little bit of a pause here and waiting for a little clearer entry. If we just wouldn't have had that intraday rally yesterday, we would have had a really easy oversold bounce trade. It would have worked out extremely well. And it would have yesterday if you were quite nimble and got out when the S&P was up 200 points yesterday. But it gave all that back. We finished relatively flat. We tried to rally this morning. We've got just a touch of a bid right now in the markets. So we had the rally, we sold off. We need to see where we close today and how far this upward move can go at this point in time. But to answer your question, these are more challenging times. It's easy when we're oversold, we're on support, we're way away from the 10-day moving average. We've had a vertical move to get a bounce. And like I said, it just took a lot of that energy out with that rally. Without that headline that occurred yesterday, and you always wonder about nefarious motives, did somebody post that on social media just so that they could get an oversold rally? The shorts they're pretty savvy, and they may have sensed, as we talked about over the weekend, that we were oversold and sentiment was extremely weak, and it would be quite easy to initiate a rally. One single little comment like that did it, but it was pretty short-lived. So right now we look at BlackBerry. This 5-wave pattern is disqualified. We're highly likely working our way back down to $2.50 because that was support back at the end of the year before the election. We're probably going to erase all of that at this point in time. So yeah, pretty rough on BlackBerry.
Yes, indeed. And that was a little bonus one there, apparently, because I misread the question. It was on just charts and TA and the relation to Bollinger Bands and moving averages.
Bollinger Bands. Well, Bollinger Bands are really difficult when you have a move like this. I used to use Bollinger Bands, very familiar with them when I started the whole strangle thing and figured out where the best delta gamma relationship was, and had a book published on it and all that kind of stuff. The indicator that I used in those times was Bollinger Bands. So when they would pinch together, a squeeze, as you know, if you're familiar with Bollinger Bands is what they call it, that works the same as the ADX does, as far as giving an indication that we've been consolidating for a while and we're ready to break out. What I found over time was that I trusted this ADX a bit more when it got to extreme point lows, that we were closer to having a breakout. But I don't have any problem with anyone that likes Bollinger Bands. I just came to like the ADX better over time. And you can see that the ADX is moving up, which means there's strength in BlackBerry. So that's why I think that we're likely going to see that continued move down to 250. But from that point, I'm not sure. But Bollinger Bands in a squeeze mentality can help initiate when breakouts are going to occur as well. Like I said, I just came over time to trust a low ADX as more of a reading than a squeeze in the Bollinger Bands. But if you know the Bollinger Band rules, then you can give those a general idea. But I would encourage you, if you're watching Bollinger Bands, to keep the other rules that we talk about in place, as far as no security in time frame gets too far from the 10-day moving average for too long. Vertical moves get retraced. Keep all that stuff in mind when you're looking at Bollinger Bands, and I think you'll find it'll improve your trading if Bollinger Bands is one of your key indicators. So pretty familiar with it. We used to look at that a lot.
Thanks, Rob. And I think you covered the moving averages succinctly in that answer as well. So we'll go to a question here from Alex. What happens if the Fed doesn't cut rates in May?
Well, gosh, who knows where we're going to be in May in the markets. But even though the Fed Fund Futures is now priced in 100% chance in May, it's hard to argue. The Fed Fund Futures, if you want to know the guidelines, have a really high track record when they create an 85% chance or more of a rate hike or cut. Either way, it's got an amazing track record of being right. And we're at 100% on a May rate cut. So your question is a really valid one. If the market is pricing in 100% chance of it and it doesn't happen, we'll see another big leg down. I feel really confident in that. I think that's the only wild card right now that could be holding the market from just Armageddon, is noting that it's extremely likely, barring the bond market throwing a wrench into the works, it's extremely likely that the Fed will cut rates, if not in May and June. But if we don't see that May cut when it's 100% priced in, that disappoints the market. The market doesn't like to be disappointed, and we'll see another leg down. That's highly likely what'll happen. I still think May is a wild card, but with what's going on now, we've got a lot of time between now and the May meeting. So if things continue to get ugly, then the Fed Fund Futures may be correct. And that could at least soften some downside on a rate cut. It depends on, do they just start with 25 basis points? Do they jump in like they did in COVID, 2008, et cetera, with big rate cuts, and throw the quote kitchen sink at it, was Chairman Powell's comments during COVID. We just have to wait and see. But I do think we need to keep a really close eye on the bond market, because if rates turn and start ticking back up, and thank goodness that wave 5 pattern on the 10-year became disqualified, that was really scary. The Fed can feel a little more comfortable on cutting rates if we don't see rates move significantly higher between now and then, and indicate that we have inflation coming back. That's what that would mean. And the Fed does not want to cut into a period of inflation coming back. So the other argument would be, well, how can inflation come back if the economy is weakening, if consumer confidence is really low, consumers aren't going to spend. So where do we get inflation from? And that's why stagflation is so rare. Been the 70s since we had to deal with that. Long time, 50 years ago. And it just makes things extremely challenging when you have that. So that's why I think keeping an eye on the bond market and where rates go over the next few weeks is going to be key. So if we can get rates to continue to come back down, that does increase the chance that the Fed feels comfortable enough to try to help out. I don't think they're going to say they're going to help out the markets. I don't believe that the Fed doesn't watch the markets. I believe they do. I don't know that that's one of their mandates, but I know they are aware of what's going on. But in the U.S. market update over the weekend, we did show a chart, and I might be able to bring it up and show it to you now if by chance you didn't watch the U.S. market update of what the data scientists at the Hub organization utilize. And gosh, hopefully by now you've gone to hub.com and gotten a copy of this software. If you haven't, then I don't know if you've been not watching or where you may have been, but that creates a scenario where it guides the Fed. I'm trying to see if I can find that chart to show you. I thought I had it saved on my desktop here. Maybe I don't, but yeah, I don't see it. But there is a macro chart that the data scientists look at to see where the major part of the economy is going. And we are fully on in contraction mode of the US market right now. And that could possibly play in. Here it is. Here's the chart I wanted to show you. Let me see if you can, let me know, Zach, if you can see this chart when it comes up. I know we're running out of time, but this is important for people to see. So can you see that now, or do I need to point it back over?
Nope, that's perfect. You got it on there.
So this chart here shows Fed liquidity. So the blue line is injections of liquidity. The black line is the XPX. And you can see how important liquidity is to the markets. We're tied to it now. It's market Kool-Aid now. So Fed injected liquidity big time here coming out of COVID, and we had that rally up. They pulled a little bit out, the market immediately went down. So they turned around and put liquidity back in, and we rallied again. They started to pull some out. We were able to move up. We created this divergence. So this divergence between where the S&P was going and liquidity was a good indicator that we were ready to come down. We did have SPY puts at ewotrader.com, and wish I would have held them longer. Took them off. Did not think we would move down this far this fast, but we had a nice trade, and that's okay. When you have a profitable trade, it's okay if you missed some profit. Don't worry about that. But notice where we are right now. So as the market's coming down behind the scenes, even though the Fed has not been cutting rates, they have multiple different ways. And gosh, one day, Zach, we're going to have to do this class on the Fed, but they have multiple ways of injecting liquidity other than just cutting rates. There's other things that they can do. They've in the past stepped in and bought the S&P. So there's a lot of things the Fed can do without acting like they're changing their mandate, without saying they're cutting rates, et cetera. And we do have some liquidity that's come back in. So this is an up-to-date chart of where we've been, and we're starting to meet again, which added into my thesis that we're ready for an oversold bounce. I just think, the fly in the ointment again was that intraday massive rally that we had yesterday that took away some of that. Otherwise, I feel like we would have rallied further to the upside. But I don't think this is the end of the world. And I know a lot of people are worried about that now. Even if the Fed didn't cut rates in May, they are injecting liquidity. And while that headline number would be one of those quick moves down, if you've watched, you know that oftentimes what happens right after a Fed meeting gets retraced in the next trading day. And I think that could be what we experience. I think if nothing changes between now and then, and things could change in 2 days. But if we were right where we are now, when the meeting comes up and the Fed doesn't cut rates, I think we see a big leg down on that day. But with the other means that they have to inject liquidity, that could get bought into right away. So, yeah, really good question.
Absolutely. And yeah, that chart is very intriguing. I always look forward to the data scientist meeting we have weekly and being able to look at those macro phases charts. Looking forward to that Fed meeting, Fed webinar that we'll have at some point as well. Let's go to a couple of questions from Will looking at potential shorts. First one's going to be SMH.
Yeah, well, I posted a commentary last night that if we got a bounce, the list of AI symbols it's off the charts. In fact, I can just show you real quickly. If we go over here to the bearish list, look at that. That's the most stocks that I've ever seen on the bearish list. And I was privy to all the data that the data scientists use. They went back 20 years analyzing millions, literally millions of stocks and their moves in creating this AI system. And even during COVID, and you could argue, yeah, well, that move down was so quick. We went down hard and fast, but we came back quick because the Fed just threw, as they said, the kitchen sink at it. But when you look at this, you see all of these bearish setups that are here. The scores aren't quite high enough. We like the scores to be above 75, and the highest score is 54. But if we can get a little follow through with this bounce, and maybe come back. The shorts tried. They got it down into bearish territory, negative, but now we're bouncing a little bit and we're slightly positive on the SPY. So maybe the downward momentum has eased for a moment and maybe we get a little bit more of a bounce up here. And as I mentioned in the beginning, Will, I think if we are able to rally back up, fill this gap, get back to the 10-day moving average, that sets up a whole slew, as you just saw, of potential downside trades. It could be a record for the number of alerts that we send out if that happens. But if we stay down here and we've taken all that momentum out, you got to be way pickier on what you do on the downside. If you're already oversold and it doesn't look like you want to bounce, these kind of vertical washout type moves aren't as prevalent. So you have to be a little pickier on what you look at on a bounce in those scenarios. So good question, Will. We're just going to have to really put a lot of weight in, can we turn this rally around today, even into tomorrow? We may not, and still have more downside, but so much selling has occurred. Just going to switch the chart on you, Zach. I mentioned this too about people that were saying, oh man, if I had the chance to get NVIDIA again at 100, I would go all in. Well, some people did follow through with what they said because they actually had a chance to get an NVIDIA down here at 85. And you can see we recovered right back to that 100 level rather quickly. So will buying continue? Is there more people that want NVIDIA at 100, or are we just so gun shy right now with the selling that we had people come in and nibble at 85, but maybe we're not going to get the big watershed buying from institutions at 100 anymore? They may think they could even see a lower price, but that's exactly what happened with NVIDIA, is that we got really oversold, and some people followed through with what they said. Just wonder if it's going to be as large scale as it might have been, with the fact that it feels like maybe we're going to go lower first. So some people may be just waiting to see, you know what, I missed that 85 price, but I might get another shot at it.
Very well. Yeah, it's pretty compelling to see that NVIDIA chart down there. It'd be interesting to see how it plays out for the rest of this week and further. So we'll go to the second symbol from Will, which is XHB. Going to the home builders.
Yeah, that's a tough one, Will, isn't it? What do you do here? We had home builder sentiment, and you could argue that was bullish, right? We had home builder sentiment, construction sentiment, all those indicators at like extreme low levels. And if you're looking for a contrarian approach when there's pessimism and pessimism is prevailing, you go long, you go the other way. And so we've got extreme pessimism in the home builders industry from the builders, from contractors, et cetera. And we've got rates going down, which should be helpful to the home builders market. But the other side of the story is that when the market goes down like this, it takes pretty much everything with it. We can have downward moves and there's sectors that still perform really, really well. But when you're just tanking to the downside in the markets, people sell first, ask questions later, and everything tends to go down. But we're sitting right here on this 100% support level from this zigzag. It's a beautiful zigzag pattern. The wave 5 is in the lower half of the tap box. Rates are coming down. I would argue, Will, I'm not arguing with you. I would just argue in general, or opine, maybe a better word, that if we can calm down on the selling, and I'm not sure we're there yet, but if we do, I think this could be a place that gives you a really quick snapback, because rates coming down is going to bring buyers back. Now, will it be as many as there was before because they're looking at their IRAs and 401ks and seeing the big chunks that have been taken out? Probably not. But it should create at least a renewed bid of some degree in the home builders market. And that might get us at least a bounce back up here to this previous fib level. So, Will, I think as always, you're on to the right area to watch. But we have to wait and see. The market has to calm down, bounce a little bit higher, get back to that 10-day moving average, get the VIX back down. And if all those things play out, I would argue that you probably are set up for more of an oversold bounce in XHB than a lot of other areas. So I think you got the right one on your watch list here. I wouldn't pull the trigger yet, but I'd certainly be watching it because you're at 88, and I think we could move back up towards that 100 level. Could be a nice, quick reflex trade. So I'd keep an eye on that one, Will.
Very well. Thanks, Rob. I see we are a minute after time as well. So instead of going over to the platform to show the posts with FXI being the selection, I'll just give you one more question, but I will quickly differentiate between the two. If it was going to be an official case study consideration idea, then we would have all of the real-time data and, or excuse me, just it would be more of the data you would see for paper trading with your brokerage, where there would be real capital on the line in theory, but it instead would just be the data that you would see for whatever stock you might have. You can have the supporting evidence as well in the commentary, and select the time frame or periodicity for what the trade you're looking at would be. We'll finish with a question here from Bruce with a couple of requests on could you please give me your opinion on the fact that today on the SPY we see a 3 blue, not purple on the weekly chart, and on the weekly chart it's a purple 4. I'm a little confused how that could happen.
Yeah, happy to go through that. Really good question. So here's what you're talking about on the daily chart. So the wave 3 is showing as it could still be active. And then you were asking if we go to the weekly chart, let me bring in enough data to give us the Elliott Wave count on the weekly chart. And once we get there, we'll be able to see. There you go. So there's what you're talking about. The wave 4 is purple. So what does that mean? That means that when you go back and look at the daily chart, the feeling is the wave 3 is still in play. It's still active. It could go lower. By having this wave 4 in purple on the weekly chart is suggesting that this wave 4 is now confirmed. And it doesn't mean you can't go lower in the wave 4. I want to be clear on that. Whereas the daily chart showing the wave 3 still being active, well, we could go lower, anything could happen there. But the weekly chart is suggesting that we're definitely in a wave 4 correction, which means at some point in time, it doesn't tell you when, we could go down to 61.8. In other words, this 4 could go lower. So just noting that when it turns purple, it means that wave is confirmed. It doesn't mean it's over. There's an important distinction between those two. So we're definitely in a wave 4, at least the algorithm thinks so on the weekly chart. Perhaps that low holds, but it doesn't have to. That purple 4 could sneak down just a little bit further and still stay that we're confirmed. But it is telling you that too much more downside from here is unlikely, at least right now. But it doesn't mean it's over. We go down to 61.8. That could be a target to hold. But I do think on a weekly chart, and I think this is, if you're looking for a bounce, if you have some bullish tendencies left, this is the chart you want to focus on more. Now, obviously, it's longer term, so that doesn't tell us what's going to happen over the short term. But you look at, and I've noted this a few times in recent webinars, how well the weekly chart just follows the 10-day moving average. It doesn't oscillate from it too much. It stays right in line. And where we are right now on this wave 4 low is pretty darn separated from that 10-day moving average. So the weekly chart is showing you that we are oversold, and maybe we do some backing and filling for a couple of weeks, even if we don't see much of a rally. And I think a good comparison, we're just going to run a little bit long here, Zach, but I think this is important to go back to COVID. And here's where we were during COVID. And you can look at where that chart is. Now, you can say these are different times. This is a different scenario than COVID, but man, we thought the world was coming to an end. We shut down the country. We shut down the economy. And this was the move down. You can see the separation from the 10-day moving average, and look what happened. We came back. One thing I can tell you from experience is the market will bottom before the data gets better. So the market's always looking ahead. We may have put the bottom in, we may not have, but I will tell you that the market will bottom and turn back up. It always does before the economic data and everything else turns to show that, hey, things are getting better. The market anticipates that. So yes, COVID was a quick flush to the downside, and then we recovered and moved back higher. But I just want you to look at, even during COVID, we didn't separate too far from the 10-day moving average. Now, granted, we're much higher on the SPY than we were back there, so take that into account. But you could argue that we're pretty much in the same area from the 10-day moving average as we were back then. Yep, different times, and we're really worried about where things could go in the market. The biggest concern to me, and if people are wondering, I know there's a lot of people who don't like the tariffs. I know all the negatives of tariffs are being cited. I don't think it's going to hurt companies nearly as much as some think. Yes, it's going to have an effect on earnings. Yes, if companies do bring their manufacturing back to the U.S., they're going to incur costs to do that. It's going to take time to do that. All those things are very valid concerns and questions. But I think that the amount of market cap that's been wiped out has really just taken the froth off. We were overvalued. So we had all these things set up. liquidity, etc., that set us up for this correction. I personally didn't think the correction would be this severe. I just felt like the tariffs had already been priced in. Yes, the tariffs were a little more severe than what people had thought or expected. So that was a negative. But a lot of this is normal course of correcting overbought scenarios. And when investment managers, et cetera, know that we're overvalued, know that our price to earnings ratios are very high on average, they're looking for an excuse to sell. And the administration gave it to them with these tariffs. And we had this big move down. But going back to that weekly chart and sitting on a 50% correction, that's a level that could hold. And that's going to take a few weeks for that to all play out, because the 10-day moving average is way back up here. But you can make an argument that we could at least channel sideways here a little bit over the next few weeks, and then maybe figure things out from there.
Very well. All right. I think we'll wrap up. That was some valuable insight to add at the end there, Rob. I do want to remind everyone that the FXI post will be available on the platform, the Hub platform feed that is here very shortly. And as I've said before, whether you agree or disagree, opposing opinions, what makes markets. And if there was no, if everyone agreed, there'd be no transaction or trade to select or for there to be any open interest, rather. So it takes both a buyer and a seller, someone who agrees and disagrees. We just ask that you be respectful and, of course, share your supporting evidence for whatever your opinion may be. So FXI, again, will be available here shortly, and I'll pass back over to you, Rob, to wrap things up.
All right, sounds good. So we had a lot to talk about. Thanks for your questions. As always, very intelligent questions. Love TradeFinder, such a great community. Nobody else that thinks you would want to participate in this, please let them know. And they can go sign up for TradeFinder at ewotrader.com or in the links provided each week in the U.S. market update. So thanks, as always, for your attention. We'll see where we end up today in the market. I think that's going to tell a lot. And yeah, I'm just not as encouraged by the bounce scenario as I was before that big rally yesterday. But perhaps we can generate some sort of a rally into the close. We went positive and we've turned and gone negative at this moment. So we'll just play this out over the next few weeks and we'll be here to tell you what's going on. So thanks for taking out part of your trading day. Thanks for your work behind the scenes, Zach. And hope everybody has a great rest of your day and look forward to talking again soon. Take care, everybody.